Okay, now let's talk about cash outflows for operating activities. In the previous recording, we talked about cash inflows, cash receipts from customers, and let's talk about cash payments to suppliers and employees. That's the line. Because of the convention, we use that line, but when we say cash payments to employees, we don't necessarily meaning to just include wages and salaries. It's essentially that is cash payments to expenses. It's just the terms or the line that we use due to convention, but you can change it to cash payments to suppliers and other expenses, and that's fine. Because in fact, a lot of businesses do use what fits them for their purposes. Now, in this line, I want to show you this first and then that one. But on the cash flow statement, either in the assignment or in the exam, you will combine those two amounts. But let me separate that out for you first so we can actually see how they work. So when we think about cash payments to suppliers, essentially we are looking at purchases of inventory. So what we want to know is how much inventory have they bought during the year, and of that, how much have they actually paid? So purchases can be made from cash payments, or it could be on credit. So if they bought purchases on credit, then it will be on accounts payable. For example, now they bought this much of purchase inventory, and they put some on account, meaning they still owe money, they haven't paid yet. Then we can work out how much they actually paid to buy the inventory. For instance, if I said this was, say, $10, and they have $6 on account, that means they paid $4 of cash to buy that inventory, yes? So that's what we are after. We can get that from the income statement, and we can get that from the balance sheet. Now then, by using these two amounts, we can work that out, and that goes to cash payments to suppliers. Difficult part is that, well, unless the businesses use periodic inventory system, we won't know the purchases. Remember from week 6, there are two types of inventory system, the perpetual and periodic. If the business is using perpetual inventory system, that means on their income statement, they will have cost of sales, not purchases account. But if they're using periodic inventory system on their income statement, they won't have a cost of sales, but we need to calculate, well, we can calculate it because they will have a purchases account. So on the periodic inventory system, how they calculate cost of sales is opening balance of inventory plus purchases minus purchases returned and whatnot, and add freight inwards and things like that. But to simplify, this is how we calculate cost of sales on the periodic. So the cost of sales on the periodic is calculated as opening balance of inventory plus purchases and minus closing balance of inventory. And now, if the business is using periodic, that means you will have a purchases amount on their income statement, then you can just simply use that there. So you know exactly how much they bought, exclude or take or adjust for accounts payable, that it will tell you how much inventory they purchased with cash. However, if the business is using perpetual, then we won't have a purchases account. So we need to work that out. How? If I rewrite this so we can work out purchases. So if we are using perpetual, we don't have a purchases account. So that's the question mark. That's in question. We don't know on the perpetual, right? Because we have a cost of sales, but not purchases account. But if I rewrite this, I send this, I leave this one and send this over to the side, right? Then cost of sales minus opening balance of inventory plus closing balance of inventory, because these two are sent over, so they change plus minus, right? So that's how we work out purchases for perpetual. Once again, if they're using periodic, they will have a purchases account, so you don't have to go through this because it will be there. But if they're using perpetual, that means they don't have a purchases account. Therefore, we need to work that out by using cost of sales from the income statement, and then you can get this amount from the balance sheet. That's how we work out purchases. And from there, we add opening balance of accounts payable, take away ending balance of accounts payable. The reason why I wanted to go through this is because now, as you can see here, opening balance of inventory was negative, subtracted. Closing balance of inventory was added. So you can't just think that, oh yeah, we add opening balance, because with the cash receipts, we add opening balance of accounts receivable. And here as well, we add the opening balance of payable, accounts payable. We can't just take that as, oh yeah, we add opening balance and take away closing balance. You can't do that, because now these are the opposite. Why these are the opposite? Because this part is to actually work out purchases. So once we worked out purchases and then we adjust for accounts payable, then it will tell us how much cash purchases they made. So that's why we are doing this. So that is to essentially work out purchases for perpetual inventory system. Once again, if you're using periodic, you don't need to do this because you know exactly how much purchases are. But if you're using perpetual, then we need to do this bit to work out purchases and then adjust for accounts payable. This is, with regards to accounts payable, it's the same logic as the cash receipt as in accounts receivable there. Opening balance of accounts payable. So let's say that that's 1st of July and that's 30th of June. And that's our current period, yeah? If they had an opening balance of accounts payable, that means previously they bought inventory. And then they hadn't paid then, so they still haven't paid. They put on credit accounts payable when they bought inventory. Now, opening balance means that they still haven't paid then. So when this will be paid? In the current year, right? That's why we are adding. So once again, the purchases, which is cost of sales minus opening balance of inventory plus closing balance of inventory. That is to work out purchases. Yeah, from there, we add the opening balance of accounts payable, because that amount, the inventory was bought in the previous accounting period. However, this will be paid in the current period. Yeah, so that should be included as cash outflow for the current period. Now, however, if they had ending balance or closing balance of accounts payable, doesn't matter. Ending balance or closing balance of accounts payable means that they bought inventory during this year, but they haven't paid. When would they pay for this? Next accounting period, right? So that's why we need to exclude the closing balance of or ending balance, same thing. That's why we need to take away closing balance of accounts payable. Now, that is to work out cash paid to suppliers. Essentially, how much inventory have they bought during the year and paid with cash? That's how we work out. Now, so that's the cash payments to suppliers. Now we need to work out cash payments to expenses. There are two things that you need to understand here. When we look at the income statement, then we can get expenses. Now, this could be paid already or still not paid. So then if that was the case, it will be on expense payable. Still a liability. So if for instance, electricity expense was, let's say, $15, but when you look at the balance sheet, they still have electricity expense of $8, for example, that means they paid $7 of electricity expense, yeah? So that's the same logic as we've done before. So then, in order to work out cash payments to expenses or for other expenses, cash payment for expenses, I would say, then you get the expense from the income statement. This could be wages and salaries, or this could be other expenses, other operating expenses. However, when you get this amount from the income statement, you will exclude non-cash expenses, such as depreciation expense or loss from non-current sales, sale of non-current assets, things like that. Those two, I think these are the common things that you'll come across. If you have bad debts expense, now this will not be included there, no, because this would have been adjusted from cash receipts. Remember, bad debts or doubtful debts reduce cash receipts, so that was adjusted in cash receipts part. So do not include depreciation or loss. If you have any, just ignore them or take it away. If depreciation was included in there, then you need to take that away because that's not cash expense. Remember, we are only looking at cash outflows, cash payments to for other expenses. So you get that from income statement. And same thing here, we add opening balance of other expense payable, so expenses payable, and take away closing balance of expenses payable. The logic is the same as above. Now, opening balance of expense payable, that means it's incurred last year, but they didn't pay then, so this will be paid in this period. That's why we added in. Ending balance of expense payable means that it incurred this year, but it won't be paid until next year because it's a closing balance, yeah? That's why we need to exclude it because it still hasn't been paid. So that's one thing. Now, if they have prepaid expenses, it's the opposite. We take away opening balance of prepaid expense and add closing balance of prepaid expense. The reason for that, prepaid expense meaning that you paid in advance. So when you think about prepaid, if you prepaid, for instance, insurance, prepaid insurance, for instance, then credit cash, that's what we mean by prepaid, right? You already paid for it. And then when used or expired, that's when we recognize insurance expense and we get rid of prepaid insurance. That's what we do. This is an asset, right? When used, that's what happened. And this is part of your adjusting entries, right? Now, then when we look at cash flows, things that we are interested in is this. How much cash did they pay? Here, when they recognize insurance expense, so that will be included in your income statement, there is no cash involvement. So this will not affect cash flows, but this will. However, by looking at the income statement, we don't know how much. By looking at income statement alone and we get the insurance expense, we don't know how much they actually paid for it. So when we look at the timeline, for instance, that's 1st of July. If you had an opening balance of prepaid expense, when was this paid? They already had opening balance. Once again, opening balance of current period is the ending balance of last period, right? That means it was there in the last period. It was paid in the previous period. So previously, they would have recognized then. However, as this is, you see, this is an asset. When this is used in the current period, that's when they will recognize as an expense. However, there is no cash. That's why we need to minus opening balance of prepaid expense, because opening balance represents the cash paid previously. That's why we need to take that away. Then if you have an ending balance of prepaid expense, that means this was paid in this year, but it will be used in the future period. But this was paid in this period, although it's not expired or used yet. That's why we need to add closing balance of prepaid expense because although this is still sitting as an asset, it's not included in the expense, but they paid for it. So we need to include that. That's how we work it out. So going back here, that's how we work out expenses paid. Yeah, cash payments for expenses. So expense from the income statement, we add expense payable, take away ending balance of expense payable, and then take away opening balance of prepaid prepaid expense, if any. Sometimes they don't have any. And then add the closing balance of prepaid expense, because that means that it was paid during the current year. That means it was paid last year. This means this will be paid in the current year. That means it will not be paid in the current year. That's why we take it away. So by doing this, you can work out cash payments for expenses. Once you have done this, you add this with this. That's how you can work out cash payments to suppliers and other expenses. So if I summarize it, cash payments to suppliers and employees. So basically now we need to work out purchases first, unless they use periodic. So if they use perpetual, then you need to do this. That's how we work out purchases and then adjust for accounts payable. So that's to work out cash payments to suppliers and then cash payments to other expenses. So expense plus opening balance of expense payable, take away closing balance of expense payable, and then take away opening balance of prepaid expense and add closing balance of prepaid expense. That's how we work out cash payments to suppliers and employees. And as you can see, it involves a lot of calculations. So most amount of marks will be writing on this part. If you have any questions, please post on the forum or send us email. But try this, apply this if you can work that out.